We've got Matt Orton joining in on the show right now from Raymond James Investment Management to talk about his thoughts on what the global markets are up to. Matt, hi. Good to have you on the show. Morning. Just wanted to understand, what is it that you're making of what's happening in the US markets? Everyone's been waiting for the bubble to burst, but in the near term, it's more the inflation data, I guess, that's on everyone's mind.
Good morning, Aisha. It's always great to join you. And I view the U.S. market and the global setup almost as you've described in the introduction to the segment, which is that it's fairly constructive. There's nothing within the market setup right now that to me seems very, very pernicious, where there's massive risks that could potentially take the market down significantly. There's certainly a lot of, I'll say, intraday volatility, especially reactivity to headlines. And that's the one thing I encourage investors to avoid, is trying to be too reactive to headlines or extrapolate too much with respect to what they think the future might be on tariffs or anything that could be inflation related. And instead let the data come in and really focus on the micro. In this sort of environment where there's so much macro noise, it's very helpful, especially coming through an earnings season, to look at the actual fundamentals of the companies, lean up in quality, lean into companies where you're seeing earnings and really earnings momentum starting to accelerate. Those parts of the market have done well. And what's most encouraging to me, really on a global basis, is that you are starting to see good breadth. You're starting to see not just the US mega caps work, but you're seeing a lot of other sectors, particularly cyclical sectors like financials, in the US, in Europe, in India, and Japan. All of those parts of the market are starting to work, which to me is very encouraging. So you've got to be opportunistic with downside and don't chase upside while leaning into quality.
So I'll just, let's rewind 6 months forward. We are, let's say, discussing where markets are or where markets should be 6 months from now. 6 months from now, a lot of markets would have digested a lot of news flow, especially on tariff, and the way this entire AI threat which has come from DeepSeek would have become more and more evident. So exactly 6 from now, when markets would have more clarity on tariff and on AI, how do you see equities evolving?
I see the financial part of the market and deregulation moving higher. I see tariffs being used opportunistically and not having the serious negative ramifications that might be implied with respect to headlines, and perhaps maybe just a little bit more order from a geopolitical perspective. I'd like to believe that policymakers, there's a rhyme to the madness with which we're seeing a lot of the headlines come in. And I think a lot of it is to reset the global order in some way, shape, or form that's going to be beneficial to the US, and really I'll call it the Western bloc. Democratic bloc going forward. And I do think we're going to see earnings, not just in the US, but around the world, continue to pick up. And that's what's most important for driving the markets forward. And the one thing I'll say on Indian markets in particular is, consolidation can happen both through price and time. We've gone through a significant consolidation in Indian markets with respect to price, and going through a consolidatory period through time where the market starts to build a healthy base sets things up for a very, very positive move once the earnings actually start to follow. And I think they will, especially given the actions of the RBI. Hopefully, we're going to start to see a weaker dollar, or at least a dollar that doesn't strengthen anymore. And when you couple that with a more favorable energy backdrop, especially if the US starts to drill, given all of the executive actions that have happened, that provides a more optimistic picture than where we are right now. So it's important not to exit the markets or let negativity from headlines impact your investments.
Sure. But Matt, one of the big concerns for India has also been the FI exodus. Do you sense that the money will continue to pour into developed markets like the US? Because that really seems to be the preferred market.
Yeah, the US, I think, is perceived as the safety market, because that's where earnings growth is very visible. The S&P 500 is growing at 16% EPS year over year right now. You compare that to Europe, which is beating expectations at about 5%, where India has been declining. So I think the US is an area of safety, plus the dollar. And honestly, I think FII flows are going to be very tied to the strength of the dollar. If we can see the dollar start to weaken, that is going to enable value-seeking investors, which that's where a lot of the money is going, is to valuations that look more attractive where there's growth. That would lead you to passive flows into emerging markets, for which India is going to benefit. And I think once that starts to pick up, more active foreign investors are going to start looking at India because there is value, because it's one of the few places where you are getting very, very positive economic growth. So it's going to take time, and I think you have to build confidence that the dollar is not going to shoot higher.
All right, Matt, really appreciate your time and thank you for joining us. And I'm